Good afternoon and welcome to another TUG Connects 365 webinar today. I'm Gloria Nelson, your host with TUG, and as you settle in and get ready for the start of today's webinar, let me give a brief introduction for TUG, the usergroup.org, for both our current members and those of you who represent organizations that have not yet joined our online community of Infor distribution software users. We've all heard that phrase that knowledge is power, and I can say with confidence that after today's presentation, you'll be waking up tomorrow with a little more of both. TUG webinars, online forums, and member events facilitate the timely exchange of ideas and information to help you work smarter and with more confidence. Now, that is a powerful combination. If you're currently a member, it pays to get even more involved. And if you're not, please visit our website to discover why 2,300 heads are better than one to help you be the best at what you do. I'd like to just make an IP announcement. You have permission from our presenter today to go ahead and capture screenshots that you're viewing, as well as copy and paste any of the pertinent chat that will be helpful to your job. And now it is our pleasure to welcome back Brent Grover to present the other side of the coin on M&A with distributorships from the buyer side. Brent is an M&A expert, author, and professor extraordinaire. Brent, we'd like to welcome you back again. And I know that we have some people that signed up that were here from the seller's perspective 2 weeks ago. So now I'm going to turn things over to you and go ahead and take it away.
Okay. Thank you, Gloria. We'll get things started here. Okay. Gloria, is the screen sharing working?
I am not seeing you in my sightline yet. You want to hit that little blue box that says share once you've selected your screen?
Okay. Give me a second here. The little blue box is hiding. There we go. Okay.
And I have you in your second slide. If you want to go back to your landing page, that'll be great.
You can do that. How's that? Okay.
Perfect.
Brent Grover here. Welcome, everybody. It's TUG time again. Time flies, but not since the last webinar, because we talked about this 2 weeks ago. M&A from the standpoint of the seller, and today we're talking from the viewpoint of the buyer, which is great because a lot of you guys are probably both buyers and prospective sellers. So just bear with me because some of the material at the beginning is going to be similar, if not the same in a few slides of what we talked about last time. But sometimes repetition is good. And on the other hand, after all, buying and selling are mirror images of each other. So there's a lot of similarity. I popped up on the screen here some representations of some transactions that I worked on in the last 18 months or so, 24 months actually, thinking about 2020, which was a little different kind of a year. Just note that in these transactions, each of which I was representing a seller, not the buyer, but the buyers in each case are they're different, but they have something in common. Two of them are actually strategic buyers. One was Brady Corporation. The other one, as you can see, was a redemption. So the buyer, of course, was the company. But the other four, importantly, I say they're quasi buyers. They're quasi strategic, or you could say they're quasi private equity, but they were, and they are, companies that are strategic players in its distribution industry that are owned by a private equity fund. And as we go through an analysis of buying distribution businesses in 2021, it's important to recognize that your key competitors as buyers, your key competitors in many cases are going to be are not going to be strategic. In other words, not your business competitors, but rather private equity funds. Gloria, let's pop up the first poll and try and get everybody involved here a little bit. Here's a question for you about your acquisitions program at your company and what I picked four of possible challenges that are slowing down your acquisitions program at your company. And I would like you to pick one, although in most cases I imagine you would find more than one to be a part of the challenge right now, ranging from high purchase prices to overall concerns about the world and the economy and question there about getting financial leverage from your bank, your typical fund provider, and also not being able to find enough acquisition targets out there. So, Gloria, I think we've had enough time for some input. Let's see what the panelists have to say. So, 43% think purchase prices are unreasonably high. And second place, there are not enough targets to buy. So, not so worried about financing and not quite as concerned right now about the uncertainty in the world, which I will tell you from the seller's viewpoint, the uncertainty in the world is a big deal to them and is a possible compelling reason for them to sell, which is important for you to keep in mind. But you as a buyer, if you're finding purchase prices to be inflated beyond what you want to pay, I think a primary cause for that, which we'll dissect a bit, is the presence of private equity funds as competitors who want to buy companies, and they're competing with you for those companies, and they can pay a lot. Let's talk about why that is in just a minute. But thank you for sharing that, Gloria. We'll go on now to the sort of an agenda here for the things to talk about the pandemic, about valuations, about the importance of the buyer and seller having compatibility, about attracting offers, or I guess that's left over from last time, attracting sellers, which is our job as buyers, and some of the other variables in the process. So big overall question is, did we miss a window of opportunity to buy good companies at fair prices in 2020? I never like to look at it from the viewpoint of we're trying to buy fair companies at good prices. I think that's upside down. We want to buy good companies at fair prices, but did we miss a window? Maybe that there was less competition in 2020 and we should have jumped on it. And another question here, we're going to have opportunities to make a fair deal on a good company in 2021. So I want to try and answer both of those questions. But as a matter of backdrop, at this time, U.S. manufacturing capacity utilization is still at a low point. It's not as low as it was when it got down to 60% early last year, March, April last year. But it's rebounded, but only to about 72 or 73%. Manufacturers don't have a lot of pricing power when manufacturing capacity utilization is that low. Now, there are exceptions. There are industries like plastic resin where prices have been advancing and supply and demand are tight. But that's not the case in most industries. There are some other commodities that are similar to plastic resin, but by and large, manufacturers are not in a position at this point to raise prices, and consequently, distributors don't have a lot of pricing power if their suppliers don't. As far as privately owned distributors, which is this audience, mostly privately owned distributors, not entirely, but mostly, based on some straw polls, sales were down in December about 10% year over year, which means they've rebounded, but they're still down for most privately held distributors. And this is mostly looking at the industrial sector, meaning those who sell to industrial companies, whatever it is they happen to sell to them. Also, looking ahead for this year, the overall expectation consensus is about a 7% growth versus a 12% decline last year. So putting it differently, there's not much hope that companies are going to be able to get their sales back to the level they were in 2019. So we've gone backwards, and it's going to be perhaps a while before companies can go forwards. But overall expectations, sentiments have improved, but unfortunately not as much. They flattened out a bit. Pricing expectations for prices for the coming year for our products up slightly. And of course, don't forget the effect of pandemic products. It seems like a lot of distributors now say they're in the PPE business, personal protective equipment, sanitizer and gloves and masks, etc. Early on, there were very big margins that were enjoyed by some companies in those products. A lot of sales dollars, and those sales are continuing, but supply and demand are coming more into balance. So maybe at this point, the profits are not quite as dramatic. Gloria, I see you there. That may mean there's a question.
There is. We have an anonymous attendee that posted and said, what is that 7% growth rate based upon?
Hmm. It is based on a straw poll of distributors who are selling in the industrial sector. It was people who are willing to divulge over the phone some information. Now, you might say, well, that's anecdotal information. What reason do they have to give exact or precise information that you couldn't expect that? But I would say it's directionally correct, Gloria, that the expectation is that we'll have growth in this coming year, but I'm also modifying that by saying it's not really based on pricing expectations. People don't really expect their prices of their products, with exceptions like plastic products, to rise very much in the coming year. So it's based on what people call organic growth. And then one more challenge there is if they're selling a lot of PPE equipment, when will that taper off? How fast will it taper off? And of course, that depends on vaccine expectations, which nobody really knows. Okay?
Excellent. Thank you.
All right, I'll continue. Um, the pandemic disrupted M&A activity in 2020. The deal volume dropped off precipitously in the first half of the year, and the value of the deals dropped off. So there were fewer deals, but the value dropped off less than the number of deals because there were still some big deals that raised the average price. But the demand for PE funds, there's a demand for platform opportunities, and they're willing to pay a lot of money in some cases for a company that can be used as a platform for the entry of a private equity fund into a new industry segment. So there's typically a premium paid for platform opportunities, which would be a company that is big enough to have all of the functional pieces and parts, IT systems and management systems to sustain a number of companies, let's say, that could be bolted onto the framework. Strategic buyers, also a comment about them, and not PE in this case, they are looking to deploy cash. Strategic buyers have a lot of cash in the cash drawer, and that's true of a lot of distributors too. Right now, due to the combination of a backing down inventory and receivables levels, which of course tends to fill the cash till, but also PPP money, which came in handy for a lot of distributors. They're sitting on quite a bit of cash right now. I want to quickly talk about valuations. Here it is by industry, and the point here is to compare distribution with other industries, and you can see it compares multiples, so to speak. TEV means total enterprise value, which is inclusive of outside debt, not receivables, but rather bank debt. So if you look at the enterprise value of a company, it's its total value of the business, including the debt. So distribution year-to-date 2020, 7.9. Overall, that's an increase over 2019. Reason being, larger companies are actually selling at higher prices, multiples, if you will, today than they were a year ago. That's not true of smaller companies, but larger companies do sort of dominate the math here. 7.9, and you can see that's right up there with healthcare services, a little bit behind technology and a couple of other segments. But that's the way distribution looks, still very robust as far as M&A is concerned. The appetite for investors for distribution businesses is very strong. Here's a look at private equity activity. It's by year now. The year to date here is through the third quarter. That's the most current information that I have available. But you can see there are a lot fewer transactions that took place. The number of deals closed, that's the 2,753, and the overall deal value. So it bounced back in the second half of the year, but it took a big drop earlier in the year and still bouncing back from that. And here are private equity sponsored transactions also. You can see the total enterprise value was a bit up, and that's having to do with larger deals. The number of deals during the year fewer, a little less than 200, but the total enterprise value up a little bit. And then if you look to the left axis over there, you can see what that multiple looks like. It doesn't translate into a specific size company, so we have to look at that, and we will. So here are leverage multiples for companies with an enterprise value, distributors with an enterprise value less than 50 million. I should say not just distributors, all companies with a leverage multiple of less enterprise value of less than 50 million. What this is saying, the red bar, what that is saying to you is in the second quarter, banks, which is the usual lender of choice for transactions in our space, in our size range, they were willing to lend less than 3 times the EBITDA of a company that you were trying to buy. So if you were going to buy a company at a 5.4 multiple, they were willing to basically finance half of it. And you have to put 50% down. And as a buyer, you usually want to enjoy leverage more than that. And private equity funds certainly want to enjoy leverage. Looking back to the third quarter of the prior year, it was up to 4.2. In the third quarter of 2020, it bounced back to 3.2. But that has a direct bearing, that leverage multiple has a direct bearing on how much financial buyers especially are willing to pay for companies. And that often is what drives those big multiples that we see and that you guys experience as intense competition in the marketplace for companies that you want to buy. Here's a breakdown of total debt for a target company divided by EBITDA, which is a proxy for cash flow. So you can see there in the third quarter 2020, that multiple number was 3.7, and I would say today it's higher than that. Maybe it's 4. I don't know. I don't have any information to back that one up. But if it's 4, that means if you're going to pay a multiple of 8, you have to put down about 50% of your own money. So, it varies based on working capital requirements and other things, but just know that the higher that number goes, the more private equity companies are willing to pay higher prices. As far as strategic buyers are concerned, there's a lot of cash on corporate balance sheets. So this makes strategic buyers much more willing to deploy that cash for acquisitions because they feel they have the breathing room to do so. And this cash balance, the good news here applies to you too, as well as other strategic buyers. Let's do another polling question, Gloria.
Okie doke. I'm going to launch that. And while we're launching that, Brent, you might want to speak into this, although you might be planning on covering it here shortly. But we had someone post, how do you value a business with little or no profit, as we're waiting for those responses to populate?
That's a good question because it's hard to do that. And if you're sort of hooked on the idea of expressing company value in terms of a multiple of EBITDA, what if there is no EBITDA? And that's the challenge. Companies that don't have any EBITDA are still worth something. They may be worth a lot. And it depends in some cases who the buyer is. A strategic buyer might look at a company that doesn't have a lot of EBITDA and say, well, under my ownership, I could really do well. I'd love to get my hands on that book of business, those sales, those gross profit dollars, and I can justify paying a pretty good price because when I get that company, I'm going to run it a lot more profitably than the current owner does. I'm going to get better margins because I can buy better. I can tuck this operation into my company and reduce a lot of overhead costs. I won't have to pay those owners who are overpaying themselves and so on. So yeah, you can value it, but oftentimes you revert to trying to value the company based on what your discounted cash flow expectations are under your ownership, which is the old discounted cash flow sort of MBA quant method of valuation. Another approach is looking at the asset value of the company, the receivables, inventory, and the goodwill that you're obtaining from their customer base. So yeah, you can definitely put a pretty good value sometimes on a company in that category. So here we are with our poll sharing results about where do you look for your acquisition targets, your usual method. The winner here by far is our executives out there searching for opportunities. And I think that's a good thing, and I think it's also sometimes not a good thing because that means that your reach is only as far as the personal contact levels or the rumor mill, which is the next one under there where it's at 27%. Most are not looking for an investment banker. We're not Berkshire Hathaway and waiting for somebody from Goldman Sachs to walk in the door with an investment idea. But I will tell you also, more and more sellers in distribution today are looking at hiring a banker to run a process for them, meaning they want to reach out and see if they can find some private equity fund potential buyers because they know they're paying good prices. And they also want to maybe dig deeper into Strategic buyers they hadn't really thought of, or people they don't know. So there are limitations to using the executives or the casual encounter approach, which is running into people at a trade show and having a drink and finding out that you might have an acquisition possibility there. But I would suggest that acquisitive distributors broaden their search horizons beyond their own executives' personal contacts and even the possibility of rumors and connections out there. And one way to do that, of course, is to just have a disciplined search process, do some database analysis, put somebody in the company with a keen analytical mind to work and trying to look for targets. I know of a couple of distributors with whom I've worked, and they have been successful with having a search company go out there. One is a European company looking for U.S. acquisitions, and another is just a company up in the Northeast, and they really knew mostly about what was available in the Northeast, and they wanted to expand into the Mid-Atlantic and the Southeast, and they used a search company to help them find targets, and they've made three acquisitions that way. So, okay, I don't want to spend too much time on any one thing. Of course, we don't have a whole lot of time, and we're already about 20 minutes into this, so I'm going to be careful, but I'm going to try and get a lot done. So please pay attention carefully because I may talk a little too fast. I want to look at valuation now in a couple of different ways. And one way I want to look at it, and you see those red arrows up there, is comparing valuations of distributors when we acquire companies with the stock market, if you will. And you see companies, great company there, Fastenal, and the first line there has a red arrow over their EBITDA margin, which is 22.8%, something many aspire to but few achieve. And notice also their price to sales ratio for a share of stock. I mean, that's not buying for buying the whole company. That's a little different, isn't it? But buying a share of stock, people are paying 4.9 times sales. Can you imagine going out and buying a distributor for your company and paying 5 times sales? And the answer is, well, probably not. What you have in mind is probably more like 30% of sales. In fact, what's in that little box there on the right there with the it says 6 times EBITDA. In writing 2 books for NAW about merger and acquisitions activity in wholesale distribution, and one was in a number of years ago, in 2000, before 2010. The other one was much more recently, 2017, I think. But came up with the same numbers both times, looking at over 200 deals that were self-reported. The median transaction was around 6 times EBITDA and about 1.6 times net book value, which means a 60% premium over book, and about 30% of sales. And that's a long way from comparing to Fastenal. But even if you look at one of the lower performing companies on that chart, you'll see that I think it's not HD Supply Holdings. Oh, sorry about that. My view is slightly blocked here. Okay, the lowest one on there sold at a 80% of sales, and that was Genuine Parts. I'm not knocking Genuine Parts. I shouldn't have said that. Motion Industries is a big chunk of Genuine Parts, and it's a very fine distribution business. It's not the only business they have, but please note, they have a 7.2% EBITDA margin, which is more like what you and I are accustomed to. And their valuation in the stock market is at 80% of sales. So it's hard to compare those publicly held transactions with what we do in M&A with smaller companies. So the box at the bottom is more calibrated to our world with EBITDA under 2 million. And this is based on my sources of information, which is including being actively involved in the business, not a scientific analysis by any stretch of the imagination, but also I'm on the board of advisors of a private equity fund that looks at a lot of wholesale distribution transactions because that's the only type of company that we buy at that in our portfolio there. And under 2 million, where I am saying yesterday's multiple might have been 5 to 6 in a very strong market before COVID. Today, probably 5 times, and 2 to 5 million EBITDA, which is more of a mid-size, in this world, a mid-size deal. It's still small in the grand scheme of things, 6 to 7 times yesterday, might be 5 to 6 today. So I'm suggesting maybe we've lost a turn of value in that category. But at the 10 million and plus EBITDA level, 8 to 9 is still very much going on. And outlier transactions at even higher levels than that. And an outlier could be a strategic transaction, especially if you look at the public market, like Westco made an acquisition of Annixter Brothers, and that was earlier in 2000. Of course, publicly held is different. It's all relative, but it's different. But under 2 million EBITDA, you don't have a lot of competition there. Private equity funds might be looking at companies there as bolt-ons to their existing platforms. But for them, the juice isn't really worth the squeeze generally to chase after a company with less than 5 million of EBITDA, because the cost of putting a transaction together for them, private equity, including legal and accounting costs, quality of earnings, and market study, that type of expense is really too much to put onto a small transaction. 2 to 5 million, that you will find some competition from them in that area, but those are mostly bolt-ons to their portfolio companies. So I'm going to depart from that now and go into a little more, let's say, financial analysis stuff. I'll keep it light, but I want to share something with you that I think it's simply elegant or elegantly simple. This is a profit model that's based on something originally called the DuPont model, adapted for distribution. So here's a little company, 300,000 of net income and 10 million in sales. And if you look at that fraction, you divide their net income by sales, they had a return on sales of 3%, which you may look at that and say, well, that's not very good. I'm not saying EBITDA, I'm saying this is their pre-tax return on sales. It's a combination then of their margin and sales order size, their productivity of their people, their overall expense controls. 3% is pretty good. Let me show you why. And this is something that the PE funds didn't recognize early on. With a 3% return on sales, if you then go to the next fraction, which is the 10 million of sales divided by the assets of this company, and I used a fairly typical number here of an asset relationship of sales to assets of 4 to 1, meaning there's 25 cents of assets for every dollar of sales. That's including receivables, inventory, and the small amount of fixed assets, book value that distributors have on their balance sheets. Most do not have real estate on their balance sheets. So now we have 4 asset turns times 3% return on sales equals 12%, which happens to be the return on assets for this company. And you could test that number. 300,000, which is the net income divided by 2.5 million, is 12%. And then finally, and making this a little more complicated, a little more interesting, the leverage on the next fraction is assets. We already said they're 2.5 million divided by equity of 1 million. You might say, well, Brent pulled this number out of his hat. Well, not really, and let me show you why. If you have 2 million, 2.5 million of assets, you have 1 million of equity. How much debt do you have? 2.5 minus 1 is 1.5. So you have 1.5 million of debt. So then your debt to equity ratio, which you're more familiar with typically, 1.5 to 1, 1.5 million divided by 1 million. That's very conservative, as you know, I'm sure, you recognize immediately, that's very conservative. So this is a company with not too much leverage. Their total amount of debt of 1.5 million is inclusive of their payables and their accruals, as well as whatever outside bank debt they have. And if you multiply those fractions, remember multiplying fractions is eliminating the repetitive denominators and numerators, you end up with 300,000 of net income divided by 1 million of equity, which is a 30% return on investment pre-tax, which is pretty good. It's probably better than most everybody did in the stock market last year, even though it was such a fantastic year. So a 30% return on investment pre-tax year in and year out is awfully good. And that's why I'm saying to you, a 3% return on sales, which is in this case a 12% return on assets. And by the way, if I multiply that 12% return on assets times 2.5, which is the asset to equity ratio, that's equal to 30. And you could use a model like this to try and explain the business to your own employees who are not accounting or financially oriented people. So this works, but let me take this little company here and take it a little further. Bear with me. 10 million in sales. It has 2.5 million of GP. I just picked 25% because that's a good number for a lot of distributors to use. 25% GP means their COGS were 7.5 million. So 2.2 million in expenses. Now that number is obvious because I said their pre-tax income was 300,000. So 2.2 million in expenses, and their balance sheet looks like 2.5 million in assets minus 1.5 million in liabilities. There's a million in equity, and the liability side of the balance sheet, as you can see, the assets, inventory plus receivables, some fixed assets, which is after depreciation or after accumulated depreciation. So they have 2.5 million in assets, and we'll look at the liabilities and equity side of the balance sheet. 750,000 in payables, which is about 75% of inventory. That makes sense. The balance of debt, bank debt in this case, 750, a million in equity, 2.5 million. Now, I wanted to pick apart those components of the balance sheet because if I'm going to do an analysis of their EBITDA, I need to know what the depreciation and interest are for the company. And I started with the 300,000 of pre-tax income. I added 50,000 of depreciation, and since I said their book value of their assets is 500,000, I just used 10%. And their interest, I said their bank debt's 750,000 at 4% interest. That's $30,000. And here's the mystery number: add backs and adjustments. The stuff you need to do to normalize the earnings of a target company. And sometimes that's adding back excessive salaries from the owners, or payments that go to people in the family who aren't working there, or the owners are charging some personal travel to the business, But here's 400,000 in an adjusted EBITDA. So with the 400,000, then how much would I pay for that company if I were you? Well, one thing I need to question is that pre-tax income, is that subject to shrinkage? Am I going to hang on to those customers when I buy the company, of course? And also, what's the compounded annual growth rate for the company going forward? Can we depend on the most recent years? Not always. And then what's deferred capital expenditures? Some sellers have deferred expenditures in the IT area, in their delivery fleet, in their lift trucks. Those are their main assets. If you put an interest rate number on there, what is the interest rate outlook? And are you going to need working capital financing to finance the growth of the business as you have to build up receivables and inventory? And are those add backs and adjustments rock solid? So here are the risk factors. And if you want to be, MBA style, do a discounted present value analysis, discounted cash flow, what discount rate are you going to use and what terminal value are you going to put on your analysis? So I'll make this painless if I can. If I paid a 5% multiple for this business, I'd be paying $2 million. That's 20% of sales. That's 2 times net book value. That's 80% of GP. I don't know if you think of it that way, but I suggest you think of it that way once in a while. Look at how much you pay for every dollar of GP. And your implied return on investment, there's 20% because your 5 multiple implies that you're willing to, or you want to aspire to, a 20% return. The next possibility is, let's say you negotiate with the seller and you find you can't buy the business for less than 6 times. Well, now you're paying 2.4 million, and you can see what it does to the other numbers. You're paying a higher proportion for sales, book value. You're almost paying 100 cents on the dollar for gross profit, and your implied ROI is lower. Now it's about 17%. If you get squeezed real hard and you have to pay 7 times 2.8 million, you can see what that does to the numbers. And I'll be with you in a second, Gloria. And your implied ROI is 14%. And then finally, my last example here is a private equity fund has come into the negotiation and they're trying to bid the price up to 3.2 million. And you have to decide, if I'm going to pay that much, am I comfortable with a 12.5% implied return on investment? That's my analysis of purchase price. If I were sitting by your side when you're trying to do this, this is the kind of stuff I would challenge you with. Gloria, challenge me with a question.
Okay, Ron asks the question, are companies investing in technology to reduce the need to increase staff or maintain staff?
Yeah, they are. If they're smart, they are, and I hope they are. But it's sometimes it depends. If you're taking a long-term view, that's something you got to do, and it starts with certainly having digital. The the COVID experience, if anything, it accelerated the move towards digital. It also accelerated the the Salesforce transformation towards more reliance on inside sales, less reliance on outside sales, which is often technology driven, and the general idea of analytics has been pushed ahead. So yeah, okay, if I'm going to keep the company long term, I'm going to invest in an ERP system. I'm going to keep it current. If I'm an Infor user, I'm going to be on a current version or as close to it as I can. I'm going to make sure all my modifications are in good shape, etc. Well, if I'm thinking of selling the company, I might hold back. So to answer Ron's question, I would say it depends if you're a buyer or a seller. If you're a seller, you're probably trying to cut back on that stuff because you're thinking, I'm not going to get the benefits on my bottom line for a while, and I'm not going to get a buyer to give me a reward for my investment, so I'm not going to make it. If you're thinking of holding on to the company, then you're thinking about the long term. So long term versus short term, Gloria. That's my answer for Ron.
Thank you, Brent. And thank
Okay.
you, Ron, for posting that. We encourage those questions, by the way.
Yeah, keep them coming, guys. So just a little bit about the V-shaped recovery in multiples. And I picked three different areas here. Automotive, as you can see, in truck, which is bouncing back now. Industrial and building products. Notice that there was a drop off in the multiples in the in the first quarter of 20, and then it bounced back significantly. So now we're actually ahead in some cases of where we were in the fourth quarter of 19. So yeah, I would say we're back. But remember, please, that the valuations on the smaller companies are tending to be lower. On the larger companies, on the medium-sized companies, the same. On the larger companies, higher. Okay. This is a graphic I like to share. It's from MSC Industrial, which is you recognize as a distributor, publicly held company that they represent here with these triangles, these pyramids, the inverted pyramid. That in the industrial distribution world that they're in, and I think this applies to most others in one way or another, there are not as many large distributors as you might think. And they say large is 250 employees or more, which is, it's not that big really, but 250 or more is only 1% of the customers, and it's 39% of the revenue potential. So there's a lot there are a lot of smaller companies out there, and there are not as many buyers for them, and that's because they don't move the needle very much. So let's do another polling question, Gloria. Let's shake it up a little. About valuation method for your valuing your targets. What do you like to? Which is what closest to what you like to do? A discounted cash flow model, EBITDA multiple, looking at comparable transactions, or looking carefully at what will the pro forma be, the increment to our earnings, looking not just at the company as it is today, but how's it going to affect us going forward. So I'd like to get your input on those. And I also realize you probably use some combination of the four, or maybe even something else, like looking at asset value, which I did not include on that one. But I'm interested to know what is most close to what you do. And Gloria, if you think it's been enough time, we could take a look.
I just posted to see if we could get a little bit more audience participation. We're at 40%. We generally like to see about
Okay.
50%. So for those of you lurking in the background, jump on in and I'll give you another 10 seconds to cast your vote here.
All right, you
So
slow pokes. Let's get this show on
that's
the
right.
road, guys.
That's right. There's coming in. Okay, we're at 50%. Maybe a couple more people we can eke out from our digital online audience. Don't be afraid. You
Okay,
can
great.
also vote anonymously here. So no worries, no harm, no foul.
I don't know who's answering what, but
And we're
I'm
going to go
interested
ahead
in
and end it
what the
now.
preponderance of opinions is. Okay, let's see. EBITDA multiple. Look at that. The clear winner without peer. I know comparables are hard because it's hard to get good information about comparables. One of the problems with comparables is we're dealing with privately held companies, and when privately held companies purchase other privately held companies, there's not much information available other than anecdotal stuff, and it's not always reliable. I think it might point you in the right direction. Nobody's really looking at a pro forma increment to earnings or a discounted cash flow model, which is really only useful if you happen to have an MBA on your staff with some time on her hands or his hands to do that. But okay, EBITDA multiple. So why did people ask at cocktail parties, when we used to have cocktail parties, why do they ask, hey, what's the EBITDA multiple? And I think that's great, except it's very important to recognize what is it that we're multiplying times. The multiple times adjusted EBITDA for all those add backs and adjustments. People also, I think, tend to boast a little, and they often overstate the multiple that they actually achieved. So I think to get some sense of that, you should talk to people who are in the business and handle transactions and see what their comments are. Obviously, for a private equity fund, that's proprietary information, and I couldn't divulge it even if I had it at my fingertips. But I can only tell you that people do tend to exaggerate. So continuing on here, you remember the old prayer? I guess you call it a prayer. Desiderata. I'm taking some liberties here with Max Sermon, who wrote that, and who didn't copyright it, by the way. So this is okay. The serenity to accept what I cannot change, to change what I can, and the wisdom to know the difference. Boy, that really applies when you're buying a company, because you have to accept the reality of the company that you're buying, and that you can't change everything about it. And if you can't accept the things you can't change, and there are things there that you would like to change but you don't know how, maybe it's a company you shouldn't buy. And this gets to having a target filter, a strategic target filter, where you can look at factors like whether you want to buy a tuck-in, meaning a company you can just fold right into your company, an adjacent market company, or are you in the market for a platform, which is a totally self-sustaining independent business that you might operate as part of your company, but maybe under its own name and not under your name. You have to look at the geographic markets, customer segments, product lines and services, which is your business strategy for your company. It has to fit. Sales method, if you're selling your products on a branch-based system with straight commission salespeople, and the company you're trying to acquire is mostly using Gloria, yes?
Kathy Lundquist just jumped on, and she says if a
Hi,
company's
Kathy.
if a company's trying to be more attractive to buyers, which is more valuable, to cut our costs or promote our local presence, i.e. brick and mortar branches, thinking of what companies like MCS Industrial are doing, example, moving from local presence to a virtual hub or virtual hubs, plural.
Well, okay. Kathy, to answer that question, I'd have to say it depends who the buyer is. Sometimes people in the business, a strategic buyer is looking for a company they can buy that fills a geographic hole in the map for them, and they're very anxious, let's say, to get a distributor who is strong in the Midwest or something like that, and they really would value your penetration and your presence there, whereas another company might not put much value on your investment in technology because they're already doing that, and what you're doing is duplicating their effort. So that's the best answer I can give, Gloria.
Thank you.
Okay, thanks. So back to the sales method fit. If you're on straight commission and the company you're trying to buy, their people are all on salary, there may be an incompatibility. Are you strong in electronic commerce and they're weak? Well, that might be okay because it's an opportunity to build up their business. But let's say that you're weak in electronic commerce and they're strong. Maybe that's a value to you. You can learn from them. ERP system fit is great. Wouldn't it be nice if you're an Infor SX.enterprise user and you buy a company that's also an SX.enterprise user? Then you have power users throughout the combined organization. That's great. Are you willing to buy a turnaround? as they say, a cigar butt that has one more puff in it, and you know how to make the most of it, or do you want to only buy a company that has strength and momentum? Do you want the management team of the company you're buying to stay? Are you willing to let the owner of the company, who, if he or she's going to stay with you, roll over some of that ownership back into the combined company or into their company as a standalone under your ownership? And I would say companies, buyers today are more flexible about that, and it can work very, very well because you're able to keep the seller's interest if they're going to continue working for you and giving them an incentive to grow the profits of the business. And then by maybe some prearranged formula, they get a nice payback on the way out the second time. And this is a culture eats strategy for breakfast. It's an old Jack Welch quote. And I think it's self-explanatory. So with that in mind, and you're trying to buy companies, look at your value proposition to the seller. And it's not all about money. I think this is often not emphasized enough. If you're a good buyer, what you're looking for from your target is a diverse customer base and exclusivity and selective suppliers and a younger team, management and sales. And those are things you're looking for. You're also looking for opportunities for you as a buyer for upsides in growth and margins that you can bring to the company you bought. You can bring cost controls there that they may not have at this point, asset management opportunities. Maybe they have a superior facility that you can take advantage of. So those are upsides. That's part of the acquisition story. I would say the first three are just part of the valuation elements. The diversity, the exclusivity and selective suppliers, the younger sales team, those make a company worth a premium. But also the strategic fit and culture, which some would say, many would say, I would say, they're not negotiable. If you don't have a good strategic fit, why buy the company? And even if you do have a good strategic fit, if there's a culture clash, it's bound to be a bad situation. Now, for you cultivating prospects, and again, this is something I think that buyers often are not really fully prepared for, searching a search process to find prospects rather than just trying to go after companies that come over the transom. Your strategy might call for growth and profitable growth, I hope. And I think doing a search process to find prospects is a lot better off than waiting for something to happen. As the old saying goes, there are people who wait for things to happen, and there are people who make things happen. A target pipeline, that's like having a sales pipeline for your salespeople. And that, I think that can be very valuable to be working the pipeline depending on who's working it. Do you have somebody in your company, particularly if you're a smaller company, who's willing to make part of his or her job working on acquisition targets, cultivating them like you would going after a large new customer? And it takes time from the initial meeting and building trust to exchanging information, which is a critical factor. When do you get information about the target that enables you to determine if you want to buy it? And there's certainly an art and a science. Who should initiate the contact? Should it be the owner of your company going after the owner of the other company? Or if you're a larger organization, the vice president of business development doing that? Who's going to cultivate the prospect? Who is the seller using for legal and accounting advice? It's sometimes a real significant problem if you're trying to buy a company that has an inexperienced lawyer in terms of acquisitions and deals, or even an accountant who's not well versed in, especially in the tax ramifications of selling the business, because then they're going to get a lot of discouragement from their lawyer and the accountant, particularly if the seller is the lawyer's or accountant's largest client. They're not terribly anxious to have their clients sell their businesses. And I guess that's a blinding glimpse of the obvious. And one of the tricks in cultivating prospects is the knowing when to ask for information, how much information to ask for. Of course, if you ask for too much too early, you can turn off the prospect, but that's a very important part of the overall process. Getting close to wrapping up here, again, the seller's value proposition. I mentioned this earlier, and then I want to come back to it because as a as a buyer. This is upside down. I apologize. It's a proposition. It should say buyers. For you as a buyer, what is your value proposition compared to other people who are trying to buy the company? You need to sell the fact that you have the financial resources to close the deal, and you don't have to go around and shop for money in order to make the deal happen. You should show that you have a track record of your letters of intent closing, because a letter of intent is not binding on either party. It just shuts down the seller's process of looking for a buyer for a while you do your due diligence. You want to show that if they take a chance with you and allow you to do the due diligence, if they open up the door, that you have a very good track record of closing the deals. You don't sign LOIs all the time and then walk away. That you have a track record of closing on time. Time is the enemy of transactions, and there are a lot of buyers who they get into due diligence and they drag it out, and they're having their lawyer draft the definitive purchase agreement, which is typically the buyer's responsibility, and they drag it out, and their lawyer is a pain in the butt and is trying to argue over unimportant points. You have to show that you have the flexibility to meet the needs of the buyer, that you understand the buyer's business. And very importantly, you have a good reputation as a company to work with and to work for, because that seller's employees are going to be working for you, and maybe that seller is going to be working for you. So two different buyers out there are not necessarily anywhere close to the same level of action to a seller, even if the prices are similar. And oftentimes, if I were a seller, I would take less money from a good buyer than more money from a buyer who's not for real. And of course, there's the strategic and cultural fit, as I mentioned earlier. I suggest for you as a seller that if you don't have one, put together a deal playbook, so you don't have to delay as you go along. Think it out in advance. Who's your advisory team? A lawyer who's good at getting good deals done and not a deal killer. An accountant who knows how to help you do the valuation and help you through the financial due diligence. People who can do some research on your targets before you meet with them. You should know more about them, just like you would if you were going to call on a prospective new customer. You know more about them when you walk in the door than they could even begin to appreciate, because you've already done your homework. And you're not going to ask them questions to which you already know the answer. The ability to obtain confidential information means you have a reasonable confidential information request that's not asking them for the names of their customers and that sort of thing early on. You don't do that. And also that you have a non-disclosure agreement which the seller's attorney will feel comfortable with, that you're not trying to put something past them. That sets the stage for the kind of buyer you're going to be. Of course, your methodology of doing valuation, the types of terms that you are looking for, put together the framework of an indication of interest, which is in the event that there's a process where the seller is running a process where they're contacting prospective buyers to furnish an indication of interest with some range of values on it, that you have the ability to put together a term sheet and a non-binding letter of intent. Buyers sometimes fail to do that, and sellers put a lot of value on a letter of intent because it makes it look like you're a lot more serious than giving them something on the back of a placemat. Line up your financing in advance. Be prepared to do your due diligence team, your due diligence checklist. You have a framework for a definitive purchase agreement that you and your attorney have basically reached an understanding of what you're willing to accept and not accept in terms of warranties and representations and escrows and a working capital, a formula, and other stuff that you probably know what that is. But if you think about it in advance, you can save a lot of time. The other documents you're going to have for your seller are going to be an employment or consulting agreement for some, if not many, of the people in the company. The real estate, that's a big factor and is often a deal killer. Having an idea of what you want about the real estate. Do you want to buy the real estate? I usually say no. Why do we want to tie up our balance sheet with assets like real estate when they don't produce as much income in some cases, many cases, as we do with our business? But what do you want to do? Do you want to lease it short term? Do you want to lease it long term? Do you want to lease it with an option to buy? And what are your plans for integration? The integration plan should start long before you buy the company. So those are things that I suggest. In your playbook, the due diligence itself. These days, private equity people are very big on getting a quality of earnings report. They want to have an outside party validate, verify that everything in those financial representations from the sellers is dependable. Sometimes buyers are actually so sophisticated now, rather sellers are so sophisticated that they will do a quality of earnings report by an independent party before they put the company on the market, so they're prepared to speed up the process. Most buyers are going to want to do their own analysis, but it's great to have something to start with. The add backs and adjustments, that can be a long drawn out process, or it can be a simple one if you're well prepared. The data room is another element now, or another tool, I should say, that comes into play in transactions where the seller has his data room set up where prospective buyers can get information. Think about the ramifications of renegotiating the deal after you have a letter of intent. Of course, sellers hate it when you come back and try and nickel and dime them after the due diligence. I would recommend, if you have to do it, you have to, but it's bad to have a reputation for always coming back and renegotiating the deal, meaning the letter of intent maybe wasn't worth the paper it was printed on. And then the very painful thing of having to back out of a deal. If you do have to back out, you have to, but you don't want to have a reputation for backing out of deals. So don't go into them if you don't think you can close them. And then, of course, details here for lawyers: definitive purchase agreement and accountants, asset or stock purchase. Hi, Gloria. I know it's probably time to wrap it up. So there's stuff you need to do to be well prepared. Gloria, it's for you. Go
Oh,
ahead.
you're so kind. We do have one pressing question. I wanted to give you a heads up and let you know there are 4 minutes left on the clock. We don't want to have any unanswered questions go by the wayside.
Let's
This is
go.
provocative. This is a provocative one. What are the pros and cons of a seller remaining on as a minority owner of the business?
I think it's a good thing. If the seller's going to keep working there, and I would always try to get buyers to be open-minded to that. The seller can continue to own a minority interest in the business and have an upside in the value, meaning later on, maybe predetermined, 3 years, 5 years, maybe there's a put and a call. They're going to have a chance under some sort of a formula to get money from the second sale of the small. Let's say they held back 20%. They may get a tremendous return on that 20%. I know of one case where the seller got more for the 20% than they got for the 80%. That doesn't always happen, but I'm a big believer in that.
As the saying goes, there's skin in the game, right?
They have skin in the game. That's right.
I'm going to hang here with you because I'm not sure how close you are to the end. We're now at the 3 minute mark, just to give you an idea of time, Brent.
All right, I'm close to the end. There are pitfalls. Be careful. You don't want to jump into warfare between family members at a company you're trying to buy. It's good to know that the sellers have good advisors because they can help prevent that deal from falling apart. Watch out if your CEO falls in love with the business and wants to pay too much for it. Sit him or her down and get them a drink and tell them that they had to cool their jets. Be careful about loose lips. They can ruin deals, especially suppliers. If you tell your suppliers you're looking at a company, unfortunately, probably a 90% chance they're going to tell somebody. Watch out for deal-killing lawyers. And that's all I got.
Brent, you want to give an audible if somebody's listening and not looking right now as to how they can reach out and best get in touch with you if they have any additional questions?
Well, sure. There's my email address is on there. Of course, I love it if you buy that book. I won't get much if you do. It's my book, but I'd love to share the knowledge if you're interested. And also, I have my emails on the screen and my phone number. Send me an email. Let's make it simple. I'm happy to answer any questions.
And that would be Brent at brentgrover.com. So for
Yep.
anybody that's listening and needs that audible help, want to just be able to share that with you.
Thanks.
Brent, thank you so much. We're
Mhm.
going to wrap this up here very quickly. And I just want to say, Brent, thank you for sharing your M&A expertise today. I mean, it's just mind-boggling the amount that is in that brain of yours. And I want to thank everybody also who joined us today online for this great session. For our SX.e and CSD users that are in the group, mark your calendars for Tuesday. And if you've not yet signed up, sign up for Expertex webinar as they deliver their insights into preparing for e-commerce in the 21st century. Now, as you know, probably one of the biggest brain trusts with regard to anything in the ERPs in the distribution segment is our member forum boards. So if you still have any additional questions or thoughts with regard to today's content, jump on over and just keep the dialogue going. And for those of you who have not yet joined TUG, time to jump in and join. So go to www.theusergroup.org. And Brent, again, a big thank you. Thank you to everyone who joined us. And as they say in Hollywood, that's a wrap.